Good morning, everyone. Well, the dollar was mixed this morning, gaining against the Australian dollar and the yen, but lower against the pound, the euro, the Swiss franc, and especially against the NOK, which held on to much of its gains from yesterday. Better than expected U.S. industrial production outweighed a disappointing Empire State manufacturing survey. Manufacturing production was up a solid 0.6% month on month, and capacity utilization hit the highest level since June 2008. That's a positive sign for future capital spending, as well as a guard against deflation. In addition, the U.S. Treasury International Capital, the TIC data on flows into the U.S., showed a large rise in inflows in October, in fact the highest since November of 2008. Long-term flows, including foreign purchase of equities, are starting to recover, which bodes well for the dollar longer term. On the other hand, the euro continues to be supported by European banks returning money to the ECB ahead of the asset quality review exercise next year. Coming at the same time as the usual end-of-year squeeze on the money markets, these repayments are pushing short-term euro interest rates higher and thereby supporting the euro. However, this factor will finish at the end of the year, while the flows into the U.S. seem likely to continue. That's one reason why I expect euro-dollar to turn around next year. Today, we have the November inflation data from the UK. The CPI is expected to be unchanged at 2.2% year on year. That's close enough to the Bank of England's 2% target that it could hurt sterling, in that it suggests the Bank of England can safely leave interest rates lower for longer without any fear of runaway inflation. Also, Bank of England Governor Carney testifies to the House of Lords Economic Affairs Committee today. Elsewhere, the ZEW survey for Germany is expected to show a rise in both the current situation and expectations indices. That could provide ammunition for another attempt to break through 138, the figure, in euro-dollar. Later in the day, though, the U.S. CPI for November will be closely watched. The headline CPI is expected to rise to 1.3% year-on-year from 1.0%, while core CPI is expected to remain unchanged at 1.7% year-on-year. The reason this indicator is so important now is that the Fed has set three criteria for tapering: employment, growth, and inflation. Employment and growth have both been strong enough recently, but inflation remains far below their target. A further decline in the CPI could strengthen the hand of those on the FOMC who want to wait to start tapering, while a higher than expected CPI, or even one at the level that we're expecting, would probably increase the odds of tapering starting tomorrow. Finally, the National Association of Home Builders Housing Market Index for December is expected to rise 1.255, which would also be positive for the dollar. In short, we could see a repeat today of yesterday, a strong euro during the European day and a recovery in the dollar during the US day. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.